The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk.
All right, welcome back to another edition of the Daily Dots. Chase here, flying solo with you on Monday, July 28th, and we are 11 minutes before the close as I start off here. I'm going to go through the markets, talk a little bit about the trade deal, news from the weekend, talk a little dollar and a little oil / Russia sanctions issues and what that could mean. So first and foremost, as we have 10 minutes to go, S&P down 0.06, so essentially flat. Q's up 0.24, small caps down about 0.15, equal weight down about 0.5%, Mag 7 up about 0.5%. All world ex-US down 1.3. You have the dollar up a full 1%, which for FX is significant move higher. You have oil up 2.7%, which is a pretty big move for oil, and we'll talk about why that is in a little bit. You have Bitcoin down about 1.5, gold down about 0.7. Also notable on the day, you have copper down about 3%. Again, that dollar move probably a good bit of that. As far as yields, you're pretty flat on the front end, but 10 years up about 3 and 30-year is up about 4 basis points. And then you have vol down again on the day. And realized vol has been just nothing. We're flat almost every day, but front month VIX futures are down about 1.7%, and they're now 17.58. So the news from the weekend, obviously, we got a trade deal, air quotes, because it's kind of like a one-pager, with the European Union. I think this is kind of in the eye of the beholder. I think everyone's just kind of either confirming their own preconceived notions, but I've also seen some people that thought, the trade war was going to be awful. They're saying like, I was wrong. This is great. I've seen people say like, Europe just got smoked on this. It's terrible for them. I don't necessarily believe any of that. But what I will say is that there's no room for really firm opinions on this, because at the end of the day, we actually don't know what this means. Because just like the Japan deal, we know what the tariff rates are for the most part, but what we don't know is what these big investment numbers mean. So, they're saying they're going to buy, $600 billion worth of energy and all this kind of stuff. But is that over 1 year, 2 years, 5 years, 10 years, 20 years, like things like that. And we're going to invest, blank $100 billion. Again, is that over 5 years, 10 years, 30 years? Is it equity? Is it just cash? Is it loans? Is it loan guarantees? Like what we don't know what any of that means. It's just big numbers to make splashy headlines. How that actually plays out is what matters, and nobody knows the answer to that. So anyone that has a big firm opinion about if this is good or bad or in between they're just guessing. So I don't have a big opinion on it other than the 15% tariff part. I think it's good news for the U.S. that it's not higher. Obviously, it's also good news for Europe that it's not higher. You can make the argument, though, we have a 15% tax on goods that we didn't used to have, and because we did get concessions in the trade, lower tariff barriers from Europe, that means they get a tax cut inside of Europe. But I think one of the big things to definitely concede when it comes to these deals the last week or two is the rest of the world, while they did not have significant tariffs versus the US, they still lowered them. So we do have freer access to global markets than we had like a month ago, a year ago, however you want to look at it. And that's not nothing. That will help us export a little bit more stuff. And that's a worthwhile thing to get in return. And we still obviously have the tariff income, which personally would rather not have, because I think it is going to cause some issues, both inflation issues and some economy issues. Back on Liberation Day when we had 100% tariffs on China and all that kind of stuff, I thought, significant economic damage was possible in that scenario. Now that we kind of have 15-ish on everybody but China, like, no, that that causes some economic problems and it causes some inflation, but not like, oh man, we're gonna have a recession now because of this, or especially not just because of this, or major problems in the economy like supply issues, or like all that you can kind of forget now. And the market, the beautiful thing for this is the market gets to forget this at least until somebody doesn't hold up their end of the bargain on investments that we never defined anyway, and then we threaten to raise tariffs until they do some more or whatever. But that may happen in the future. But we also may be in a situation where the whole White House is just kind of ready to move on from this and focus on other things.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
One of the theories that a lot of people had, and that I definitely entertained myself a couple months ago, was, we'll talk a lot of trash and go hard at this, and actually take pretty substandard deals. Again, that comes down to how much of this investment's real and how much of it is a cool big sticker number headline that doesn't really play out in the end. If those big giant investments turn into trickles, or roughly what these countries were and blocks were going to do to begin with, then I think you can basically put it under the, like, we talked a big game. At the end of the day, we got some minor concessions and we moved on. But that's a worthwhile enterprise. So, and it doesn't damage our economy. So I think that's honestly probably the best case scenario. We also today, President Trump announced, we were going to give Russia, I think it was like 50 days to make some significant progress on like a ceasefire, peace talks, yada, yada, yada. That turned into 10 to 12 days today. So I think that runs through August 9th. Now, and if not, we're going to do secondary sanctions maybe, or sanctions or tariffs, like whatever the case is. We're going to go after some of their trade or exports, which is basically all commodities, in order to pressure them into coming to the table and ending, or at least dramatically scaling back the war near term. That's interesting. That's why oil's up, almost 3% today. That helps push the dollar up. I don't know what's actually going to happen. I think Russia will definitely challenge us to go ahead and prove it, after that time expires. Oil's in the 60s. So if you're ever going to poke the bear and get oil to spike, you may as well do it in the 60s. But if we do that, the August, September, October inflation prints could be meaningfully higher, and that could create a substantial pushback into above 3% inflation. That could be interesting for where we're going to be with interest rates. Obviously, it's kind of difficult to be cutting interest rates at 10, somewhere between 3 and 4% inflation. Not saying they wouldn't do it, but that is not PR fun, at least, and the bond market may not think it's a fun idea. Maybe even the currency market at some point, but so that becomes kind of maybe the most important macro thing on the horizon now, going from the trade stuff to the Russian stuff, because what we currently have is goods inflation that is definitely picking up steam because of tariffs. We have services inflation that has been weakening because wages are coming down and because housing prices are coming down to staying flat. There's a huge lag there, but plenty more good disinflation coming out of those numbers that helps the big inflation number huge, because it's a big weight in our inflation metrics. But energy has been a huge part of our disinflation lately. So if you go from having basically inflation nowhere, but just a little bit in goods picking up, to having all of a sudden, okay, goods are really firm, and now energy is pushing higher, then you better not have any labor market tightness that leads to any labor cost increases, because then you could be looking at definitely in the fours, next year. If you had a sustainable rise in oil, which I'm not, who knows, but so this gets real macro interesting real fast if if the White House sees this through and is able with any of this policy to lower Russian exports of commodities, which would hurt them significantly. So if they're serious about this, it might work because the Russian economy has gotten really fragile the last few months. Basically, looks like entering a recession. Consumption is really bad. They're basically all guns, no butter right now because of the war effort. So if all of a sudden their income gets squeezed, the domestic economy becomes a significant problem, one that they have to possibly address. So this whole thing is going to be interesting. Just got to see how it plays out, 2 weeks from now or whatever. My assumption is they test them and then they come up with, some window dressing, let's say, of, oh yeah, no, we'll stop and we'll talk, just anything to get those sanctions taken away. And then my guess is they slow play it and kind of keep bending and if not breaking the rules. But we'll see how the two sides go back and forth on that. Dollar up 1%, again, in part because oil's up. Because now all of a sudden you have inflation expectations, inflation swaps, all these things like starting to really perk up. And if oil's going to rip, then all these inflation expectations, kind of metrics, swaps, you name it, have to like break evens, have to like really levitate, puts pressure on the Fed not to cut while the rest of the world's still cutting, and doesn't have this inflation problem now. They would with oil prices, obviously moving, high enough, quick enough. But so you could have, and everyone's short the dollar right now. So you could have a bit of a dollar squeeze for a little bit at the same time that you have rates going higher and at the same time you have inflation becoming an issue again, which would also be interesting politically because it's kind of the most important issue to most voters still, sort of push inflation back up. Anywhere near the midterms would be costly. So if they're going to do this, they need to do it quickly and then get out of the way. But we'll see how it all plays out. But those are the things top of mind today. And as I wrap up here, S&P has gone green. We're up 0.02. So we're going to close pretty much dead flat. We closed dead flat. So that's it for me today. We'll be back tomorrow with more, tons of data tomorrow and the rest of the week. So that would be kind of the focus moving forward. Nothing worth mentioning today, but huge data week the rest of the week. And we have the Fed Wednesday, but much more to come. But that's it for me today. Download and subscribe at knowyourriskpodcast.com. And as always, you can find us on YouTube and everywhere else, social media wise. It for me. Have a good one. Cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.